Good morning and welcome.
Evening, actually, Michael.
Good evening. Yeah, sorry. And welcome, ladies and gentlemen. And it may be good morning for some of you, though possibly not too many. First of all, thanks to Philip Futures for organising this this seminar tonight. I've had a 38-year career in natural rubber. And one of the features that I've always felt very strongly about from the beginning of the natural rubber industry, of my involvement with the natural rubber industry, was that natural rubber doesn't get the attention it deserves from the trading community. That it is a very interesting commodity, particularly for people living in our East Asian and Southeast Asian time zones. It's to get aside from palm oil, it's the only world important commodity that actually has its center of price formation and price discovery in Southeast Asia. And so I welcome all opportunities to introduce people to natural rubber and the trading opportunities in the market, particularly in the SICOM market here in Singapore. What I think we're proposing to do is to take questions at the end. So I'm going to talk for about 45 minutes and leave time for questions. So I encourage you all as the talk proceeds, do type in your questions for the moderators to come back at me towards the end of the talk. So the title of the talk tonight's Exploring SGX Rubber Trading Opportunities, Part 1. Part 2, I think, is going to be served up early in October. Disclaimer. My background, as was announced, I became a rubber trader very serendipitously. I joined Cargill expecting to be a grain trader, but Cargill had just bought some soft commodity trading businesses. And it so happened that I started my career in rubber in London and then moved to Singapore a couple of years later and have been in Singapore since 1984. And the one constant in my career has been rubber. So it's very near and dear to my heart. So what I'm going to do today, I'm going to give you a quick run through the industry fundamentals, then have a quick look at the benchmark contracts in rubber and recent price trends. I'll look at the derivatives markets where you can express views on rubber, and then some potential trading strategies that work in the rubber market, as in many commodity markets. So firstly, I guess it's a fairly Southeast Asian heavy audience, but for those of you who've never seen a rubber tree and don't know what RSS looks like and TSR20 look like, which are the two major contracts that we're going to look at a little bit later. Here's some photographs. Beginning on the left, picture of some very well maintained rubber trees that are being tapped with their cups there. The second picture to the right is latex being collected in the cup. There are then essentially two things you can do with that latex. You can either keep it liquid and collect it the same day, and that's about 12% of the rubber crop is kept liquid and goes, the raw rubber, the raw latex has ammonia added to it to preserve it. It's then centrifuged to bring the dry rubber content up to 60%, but it's kept liquid. And that type of rubber is used in the glove industry, which is getting some focus at the moment, general dip goods, condoms, and so on. And that's about 12% of the crop. Currently there is no derivatives market for that part of the crop. The derivatives market that we have, the contracts are denominated in the base grades of rubber that are used in essentially making tires, and we'll come on to a slide in a minute that will show you how much of the production is used in different industries. But the tire industry is about 85% of the dry rubber consumption. The traditional way to make rubber was to make sheets, and the term RSS stands for rib smoke sheet, which is a descriptor of the sheets are basically you take the latex, you coagulate it by adding formic acid to it to make a sheet that's about a centimeter thick. Those sheets are then put through an old-fashioned mangle to squeeze out excess moisture, which gives the ribbing on the sheets, hence the ribbed in rib smoke sheet. Rubber is organic; it needs to be preserved, otherwise it'll go bad. The liquid latex we mentioned earlier has ammonia put in it. Smoke sheets, as the name suggests, are smoked. So the picture in the center is of what are called unsmoked sheets. So the rubber has been coagulated, the water's been squeezed out, but you're left with a white sheet of latex, dried latex, that's about between 92 and 97% dry rubber. So there's still some residual moisture in there. Those sheets are then put into smoke chambers on the racks. You can see the sheets racked there. They're smoked at about 70 degrees centigrade. Traditionally, they use rubber wood to generate the smoke for about 3 or 4 days, which gets rid of the excess moisture, and then you end up with an amber-colored ribbed sheet of rubber. That rubber is graded visually 1 through 5. 1 being clean and evenly smoked, 5 being dark, badly smoked, and various bits of dirt and leaf and bark in it. The bulk grade that is produced these days and is used to make tire is RSS3, and that's the grade of rubber. There's an RSS3 contract in Singapore, an RSS3 contract in Tokyo, and an RSS3 option on the contract in Shanghai that we'll talk to a little bit later. The rubber's packed into bales of about 111 kilos, so 9 bales to a ton. To stop the rubber sticking together, the wrapper sheets of the bale are coated in talcum powder, and the shipping marks you can see there in red are stenciled onto the bale of rubber. So that was the predominant way that rubber was presented to the international market until the 1960s. And then under competition from synthetic rubber for a material that has technical specifications to it, and in order to upgrade the sort of waste rubber that couldn't be turned into sheets, they developed a process called technically specified rubber, which today is about 70% of the production of natural rubber is technically specified. And the workhorse grade is what's called TSR20. There's a range of specifications of interest to tire makers. The 20 actually refers to the dirt content, so it's 0.2 grams of dirt in 100 grams or something within the bale of rubber. The handling and processing is very different from the original sheet. So instead of collecting the latex and coagulate, the latex is left to auto-coagulate in the cup. And so if you leave it for a couple of days, you end up with what's called a cup lump, which is, a lump of coagulated latex, which is about 35% dry rubber. The balance is water. And then that you have latex that sticks to the bark of the trees, that's collected as well. And so these cup lumps and scrapings of rubber from the trees are then sent to a technically specified rubber processing factory, where essentially they're broken down into small crumbs, washed, and recombined into 35 kilo bales, which are pressed mechanically and which are dried using hot air dryers, then pressed mechanically. Typically these days you get 35 kilo bale wrapped in polythene. 30 of those 35 kilo bales make up a 1.26 metric ton crated unit. And you see the shrink wrapped crates of each of those is 1.26 tons of natural rubber, TSR20 grade. So as I was saying earlier, you can see the breakdown. The vast majority of rubber goes into natural rubber goes into tires, with a very strong skew towards heavy vehicle and off the road tires. So essentially, the bigger the tire is, the more natural rubber there is in there, and that's to do with the physical properties of natural rubber vis-a-vis synthetic rubber. Where you've got more stress on a tire, more weight loading, more heat buildup, you need more natural rubber. So an aircraft tire, for instance, will be almost 100% natural rubber. A heavy truck tire, off-the-road tire, 65–70%. A passenger car tire actually will have relatively little natural rubber in it. On average, about 35% of its weight is natural rubber, the balance being synthetic rubber and tire cord. So natural rubber demand actually tracks very closely industrial production growth and global GDP. So you can see during the China boom of 2001 through to 2011, 2012, you had strong demand growth for tires per year, running at 5% plus a year, that correlated for increased demand for natural rubber, which led to the big bull market for natural rubber. Since China's reorientation of its growth strategy and the slower world economy 2012 onwards, you can see that there's a significantly slower growth in demand for tires, which is correlated to a lower rubber prices over the period. This slide's a little bit out of date, I guess. It was put together back in May and showed the impact of COVID on demand for light vehicle sales, and so obviously demand for tires moved through a similar trajectory. We are seeing some recovery at the minute. How much of the V-shaped recovery is still not clear. And typically you'll find the actual demand numbers are the most difficult numbers to get your hand on, that they're not apparent in real time. You have to, the hard data only comes out with a fair bit of lag. On the supply side of natural rubber, over the last 30 years, there's been a major shift. So had I been talking to you in the late 1980s, Malaysia was the biggest producer of rubber in the world. Malaysian natural rubber peaked in 1988–89 at about 1.6 million tons. And at the time, total global production and consumption would have been of the order of 4 million tons. Today, the world is producing about 13 million tons of rubber. Thailand is the biggest producer at about 35–36%, so somewhere between 4.5 and 5 million tons of rubber. Indonesia is second, producing 3.5 million tons of rubber. Malaysia, which is the green bar on the chart, you can see over the years has shrunk. And today, Malaysian rubber production is down to a few hundred, about 300,000 tons, I think it'll be this year. And then you have basically rubber grows 5 degrees north-south the equator. In areas you need decent rainfall. It's not as rainfall sensitive as palm oil. Rubber can withstand a lengthy dry period without damaging future yield. So for instance, China is a significant domestic producer of rubber in Hainan and Yunnan along the Mekong River Valley in Yunnan. Vietnam has emerged in the last 20 years as a big producer. It's going to produce about 1 million tons this year. There's been significant growth in West Africa, particularly in Cote d'Ivoire, which today is producing 600,000 or 700,000 tons of rubber. And then there's a bunch of other countries with varying degrees of production: Myanmar, Laos, Cambodia. There's some in South America and Central America. Guatemala is probably the biggest in Central America. Brazil produces some rubber, but is a big net importer. So, price trend. As you can see, the peak of the, if you like, the China bull market was in March 2011, when the price of Singapore TSR20 approached, almost reached $6,000 a ton. Historically, people have quoted rubber prices in cents per kilogram, and before that, cents per pound. In the physical market, Indonesian rubber, for instance, is still often quoted in cents per pound, but generally cents per kilo is the normal nomenclature. You multiply by 10 to get dollars per ton. So you can see almost $5,500 a ton. The low price of rubber since the Second World War was actually in 2001, when if you like, at the nadir of the Asian crisis, following the very heavy devaluations of the Indonesian rupiah and the Thai baht. I think the low price traded in Singapore was about 45 cents a kilo, or $450 a ton. So you can see it really was quite a spectacular. Prices rose 12-fold almost from the low of 2001 to the high of 2011. That, of course, led to a lot of planting of rubber in places where rubber hadn't been planted for 100 years. The last time rubber prices were at anything like those levels was back in 1908-09. And so, for instance, you've seen big expansion of rubber planting in Indochina, so Vietnam, but also in Cambodia. Laos, which traditionally isn't an area you plant rubber, it's a little bit too far north, it's a little bit too dry. But when rubber was $3,000 or $4,000 a ton, the economics looked good enough to put trees in the ground. Similarly, areas of northeast Thailand, areas in Myanmar, areas in Africa. So there was quite a big increase in plantings in the period, let's say 2006 through to 2011. It takes 7 years for a rubber tree to reach tapping maturity. Those trees are then commercially tapped for between 20 and 25 years. So from 2013 onwards, there's been a constant increase in new plantings coming to the market, and you can see that as Chinese demand slowed down and global growth slowed down, you can see that the rubber price declined very rapidly through 2015. And then since 2015, the market essentially has been trading around the top end of the cost of production, waiting for the global supply-demand imbalance to rectify. Little bit about the contracts, and then we'll talk a bit more about the fundamentals of the rubber market. So you can think of Singapore in relation to rubber as Chicago is to the grain markets. So if you draw let's say a 700-kilometer circle around Singapore, you will capture around about 85% of global rubber production. So the bulk of Thai production is in the Isthmus of Kra. So if you draw a line from Phuket across to Suratani, down to the Malaysian border is the bulk of the Thai crop. Malaysia, obviously, Sumatra, increasingly the rubber in Sumatra is in South and West Sumatra. North Sumatra's changed more to palm oil over the last 30 years. A lot of new production growth in Kalimantan. and then obviously Vietnam and Cambodia squaring that up. So Singapore sits in the middle of the producing area. Rubber can reach Singapore from anywhere in the producing area in about a day or two sailing. So since the early 80s, Singapore has been the benchmark price for natural rubber. And within Singapore, the physical market is comprised. The major tire makers have large buying operations centered in Singapore. The big processors from Thailand and Indonesia have trading offices in Singapore. There are international dealers with their offices in Singapore. So Singapore has, evolved as the global. So if you have to say what is the price of rubber, the world starts by looking at the price of TSR20 FOB Singapore. And so SICOM's main contract these days is the TSR20 contract. The market went fully electronic screen-based about 10 years ago. And over that time, the volume has grown significantly. The market now trades about 5,000 or 6,000 contracts a day. So it's a reasonably liquid contract. Some things to note about the volume profile and liquidity profile as you think about trading the contract. Because of the way that the major tire makers buy their rubber, there is very little spot market anymore. So typically a Bridgestone or a Goodyear today will be buying November shipment. And by the time you get into October, he'll be buying December shipment. And that's sort of reflected in the futures market. So if you like, in a typical commodity futures market in the West, so in America or London, typically the first 2 contract months will carry the bulk of the volume and open interest. In rubber in Singapore, it's the 3rd and 4th month tends to be where or let's say the 2nd month through the 6th month, with the 3rd and 4th months carrying the bulk of the volume and the open interest. And that matches actually with the Singapore market you can think of as a more normal futures market where, let's say, about 60% of the activity in the market is from the industry. So it's producers, consumers, dealers hedging their book, and 40% is what you might call speculative. The Japanese futures markets and the Chinese futures markets have a very different pattern. They are massively retail speculative driven markets. So TOCOM and Shanghai will have 85% of the volume and open interest with retail, mostly day traders. And that leads to a very different dynamic. The Tokyo market, the chief liquidity is in the 5th and 6th position. And in most Chinese markets, it's in the 4th month. And so when we discuss trading, that's important to remember. Generally, it's not a good idea in rubber to be in the front month of the contract. So a bit more on that. The pattern of liquidity through the day skew quite heavily to the close. So the last 2 hours of the day get a big share of the volume. Flurry of trading around the opening and 2 o'clock. Japan still has a lunch. China, I think, still has a lunch. If you're concerned about doing volume when there's volume, the last 2 hours of the day tends to be the most active. Here are the contracts that are sort of active and somewhat available with varying degrees to people to trade. So here in Singapore, you have the RSS3 contract and the TSR20 contract. And I'll talk a little bit about the evolution between RSS and TSR. In Thailand, there is a RSS3 futures contract on TIFX, but that's quite moribund, I believe. And TIFX itself is not well served by international brokers because of various rules around the who can be clearing brokers and so on. So, and then the two most active, far and away the biggest contract in rubber is the Shanghai Futures Exchange, RSS3. It's actually not, RSS3 is an option to deliver the base grade in Shanghai is actually a domestic Chinese TSR called WF or 5. With the option to deliver international RSS3. The Shanghai Futures is closed to international investors. You have to be a Chinese company to officially trade on that market. More recently, though, Shanghai has developed the International Energy Exchange also in Shanghai to encourage, to create some international contracts that allow foreign participation. The first contract was a crude oil contract. The second contract is TSR20 futures. So that contract is available for people to trade and to spread easily against Singapore. And then finally, there's the Tokyo Commodity Exchange, which is now all the Japanese, there's been a exchange consolidation process going on over the last 30 years in Japan. TOCOM is now, I think, owned by the Osaka Stock Exchange, which forms part of the Japanese Joint Stock Exchanges. Anyhow, they have two contracts. Their most active contract is an RSS3 in-store contract. The two Singapore contracts are FOB. The Chinese and Japanese contracts are award contracts in a warehouse in the country. In the case of the INE, the warehouses are outside bond, so they're not imported into China. In the case of the Shanghai Futures Exchange, you're in bond, so you're domestic China. Okay. We didn't talk about fundamentals. Let's talk oh, there we are. Okay, market fundamentals and drivers. So you might think, so rubber is an interesting commodity in that it has features both of an agricultural commodity and an industrial commodity. So quite obviously it's agricultural in the sense that it's grown, but it's a tree crop with a long life. And that gives it a very different dynamic to something like corn or wheat or soybeans, which are, annual crops where the farmer can very quickly change his planting intentions to follow price. You plant a rubber tree, you're making at least a 25-year call. That rubber tree is tapped every day. Its production is actually not very weather dependent, despite what you might read from time to time in news reports. So it's grown in a very climatically stable region of the world, 5 degrees north-south of the equator. And if you look back at production statistics over the years, there are very few years where production changes by much more than 4 or 5% in a year. And almost, I would go as far as to say that in 38 years, I've never experienced a weather market of any length in the rubber market. So occasionally at this time of year, we're getting, the monsoon seems to have come early this year, but in a monsoon year, in the monsoon period in north of the equator, November through January, you'll hear talk of rain disruption to tapping because people can't get to the trees. forget about that. It's short term, and like most agricultural crops, rain makes rubber. Once the trees have had a nice rest and a good drink, the production's very good afterwards. During the dry season, the rubber trees winter, the leaves fall off, they don't get tapped. But once the leaves come back and tapping restarts. So with rubber, you get intra-year seasonal variation, largely dependent on whether it's wet or dry, but year on year, you actually get very little variation. So rubber actually behaves much more like a base metal in terms of its price drivers, that it's the predominant price driver is changes in demand. And as we mentioned earlier, the main demand for natural rubber is truck and bus tire. Truck and bus tire is all about GDP growth, particularly industrial production growth. And therefore, that typically is what dictates whether you're in a bull market or a bear market or a sideways market. You know, as the chart says here, yes, there's some weather impact, but they tend to be short-lived. Labor shortages can be an issue. As with most commodities, a big part of the input cost is linked to the oil price. Natural rubber's main competitor, if you like, is synthetic rubber. Synthetic rubber is a petroleum derivative, and so high oil prices, it's not an efficient pricing mechanism, but generally high oil prices lead to higher synthetic rubber prices. I would say rubbers are functionally a US dollar commodity. You could say it's Thai baht, Indonesian rupiah. But the Japanese and the Shanghai Chinese markets are in yen and renminbi, so hedging your currency becomes an important part when we look at arbitrage type trades. And so I would say for the outright direction of natural rubber, the main consideration is actually what do you think is happening to demand. So if the price of, you know, well, maybe let's look at the, so if you say on a directional point of view, if we go back to that earlier slide there, so when's natural rubber next going to trade at $3,000 a ton, 300 cents a kilo? That's really a call on global GDP growth. When are you going to get 2 or 3 years of real global GDP growth at 5 or 6%? May not be for a while. So obviously, trading the natural rubber market, you can make directional bets. You know, buy Singapore, TSR20, buy RSS3. But then there are various spread trades you consider. As in most markets, you can trade calendar spreads. Unlike rubber's not a market that typically has inverses at the FOB. So the Singapore market is almost never inverted. Because rubber is produced every day and Singapore sits in the middle of the producing region, it's very difficult for the market to actually run out. Very different story in Tokyo or China, where there's a lead time. It takes 6 weeks to get the rubber there, to get the rubber awarded, and you can run out. So you see a lot more volatility in calendar spreads in Japan and China. Tends to be not much volatility in calendar spreads in Singapore. The market typically is in mild contango. Full carry in Singapore is about 2 cents a kilo a month. And as you can see from the chart, it doesn't often trade there. Typically, it's trading somewhere between flat and a cent a kilo carry. But it's a low risk, you know, a low risk way to take a view. To trade seasonal spreads, there is seasonality. I don't show it here, but you can go and see between the wintering months and the non-wintering months and so on. Then you have the intercommodity spread between RSS3 and TSR20. As I was saying earlier, RSS was traditionally the major grade. The Singapore market historically was actually RSS1 was the main contract. That changed to RSS3 in the 1990s as production and consumption patterns changed. In recent years, RSS production today is probably less than 2 million tons out of 13, and the bulk of it is in Thailand. And the Thailand processing industry has become highly concentrated, and so the futures contract for RSS3 has been suffering from very low liquidity for a number of years now. So theoretically, this becomes more a theoretical exercise than a spread that you can actually trade anymore. But it is important in understanding Tokyo and what the value of Tokyo rubber is, which will come on into the next spread. And so here, typically, this is looking third month Singapore against third month TSR20. RSS3 is intrinsically, it's more expensive to make than TSR20 because you have to collect that latex every day, and it's a manual process to make the sheets, to smoke the sheets, to grade the sheets, to pack the sheets. TSR20 uses much less labor, and it's also using it's also blending in lower grade material. And so intrinsically TSR20 is cheaper than RSS3. And so you can see here, very occasionally, back in 2000, for instance, you saw TSR at a small premium to RSS3. Most of the time it's at a discount. These days, there's a sort of average discounts about $200 a ton, 20 cents a kilo. At times, it can get significantly higher. The most active three-sheet market that's available to people not Chinese-based is in Tokyo. The most active month in Tokyo is the 6th month, and so typically you would look at the spread between 4th month Singapore and 6th month Tokyo, because if you take delivery in Singapore and ship it to Tokyo, it takes you all in, including the process of passing the quality and grading inspections and so on, 6 weeks to 2 months. And as you can see here, Tokyo typically trades around. Tokyo theoretically should be about 10 cents a kilo over Singapore to cover the costs. Very rarely does the forward position trade there because markets love an open arbitrage. They don't happen very often. So typically Tokyo trades between about 5 over Singapore and 2 under. As I say, this relationship now is theoretical. You can't really trade it anymore. But what you can trade is TSR20 against Tokyo. Sorry, we'll get to that later. This is TSR20 against Chinese 20, which is a new contract. This is a valid, if you like, arbitrage contract. It's the same grade of rubber, slightly different approval list, but one's in a warehouse in bonded zone in China, the other's FOB Singapore, and so that relationship is bounded by the cost of freight. They've shown this one in US dollars per metric ton rather than cents per kilo to fool us. But freight from Southeast Asia to China is about $30 or $40 a ton. So you can see that spread runs typically somewhere between Singapore 50 under Tokyo, under INE, and Singapore flat to INE. They've not actually shown, oh, here we are. They've not shown TSR20 against Tokyo, but essentially that's a compound bet. that you're taking a bet on TSR20 against RSS3, which is this relationship, and then the relationship between Origin RSS3 and Tokyo RSS3. Sorry, I'm going the wrong way. For many years, I used to say rubber's a market that's de-evolved. When I first started work, you could still trade options in London. The London market faded and died in the mid-1980s, and options along with them. Finally, we have an options contracts again in Singapore, just launched on the TSR20 contract last year. And so today you can hedge or speculate using options. So a producer can hedge himself with by buying a long put option. A consumer can hedge himself with selling a call option. Speculators can take highly leveraged bets with limited downside, so on and so forth. This market's embryonic at the minute, evolving, but should develop well over time. Okay, going behind time. Let me speed up. Where are we and where are we going now? You know, big sell-off in March. So prior to March, if you look back to that earlier chart, for the last 5 years, we've been making a bottom really about between $1,300 and $1,500 a ton, which is sort of top end of marginal cost of producing in Thailand and Indonesia. So if you take your price much below $1,400 a ton, you start to really hurt producers. Obviously, the demand shock that we got in March took the price well below that. The V-shaped recovery we're having is sort of bringing the prices back to that bottoming range. For the next 6 months, I would anticipate that we'll, you know, barring another downturn in the global economy, another COVID shutdown, we're probably going to be back to a 140, 160, 170 type range. As I intimated earlier, I really don't see the conditions anytime soon for a big rubber bull market, or indeed a big bull market for any industrial commodity, because global demand outlook is too subdued. Which is not to say, you know, a move from 110 back to 150 is a 30% price move. So there'll be plenty of 30, 40% type intra-year price moves. The multi-year doubling or tripling, that's a bit, I don't think that's on the cards anytime soon. And finally, a little bit of look at, you know, back to my point that rubber actually behaves a bit more, you know, you can think of rubber conceptually as being in the same space as a metal. Here's rubber against the LME base index in orange and the iron ore, Singapore iron ore swaps market. Brent crude oil, absent OPEC, crude oil also is in that sort of industrial raw material bracket. So as you can see, rubber sort of correlates with those things. I guess it makes crude oil look a bit cheap. So with that, let me hand over for questions after that quick gallop through. Minhao, do we have any questions?
All right, for the audience, if you have any questions on hand, you know, just fire away in the question box. You can see the question box on the right side of your panel. On your control panel is somewhere right at the bottom. We have the first question from, let me have a look here. All right, we have this question on hand, Michael. How do you hedge currency exposure for arbitrage strategies involving the yen and CNY?
Okay, so the yen you can hedge. So you can either hedge using FX forwards or CME yen futures. It's interesting. I came of age trading Tokyo rubber futures at the time of the Plaza Accords, when the yen would move 3 big figures a day. And so in those days, the riskiest part of your spread was actually the currency risk. So I hedge 100%. A lot of younger guys don't seem to feel the need, but in the context of a spread trade where maybe you're trying to make up 40 or 50 bucks out of the spread, 4 or 5 cents, a 2 or 3% currency move can take all that away from you. So I would encourage everybody, when you're spread trading against Tokyo, hedge your currency. I find CME currency futures very useful for that. And typically you're hedging the same way as you're trading. So if the yen, all things being equal, so if the price of rubber isn't changing, if the yen strengthens, the yen price of rubber will fall. So when you buy Tokyo futures, you buy yen, and when you sell Tokyo futures, you sell yen, and that gives you your currency hedge. Same thing for the CMY, but more difficult to hedge, and also a lot less volatile historically than the yen. I don't know. I think these days SGX has a offshore renminbi contract. Otherwise, you'd have to do renminbi NDFs with a bank, which for a smaller retail trader might be difficult to do.
All right, Michael, the next question is, what are the advantages of trading SGX rubber over, say, SICOM rubber?
I would say the main advantage is that it's more logical. Tokyo, so Tokyo is much more volatile. And there are several things that make Tokyo more volatile. One is that you have the currency risk. Rubber's a US dollar functional currency, TOCOM contracts in yen. Therefore, you've got currency volatility, and so there's an extra cost to trade it. You've got to hedge your currency. Secondly, the makeup of the market is it's highly speculative. It's not fundamentally so well grounded. So it's trading much more on emotion and momentum, whereas the Singapore market, if you like, is more, the majority of players in the Singapore market are industry professionals, so it's being driven more by fundamental supply demand, less by emotion. And then finally, you've got the fact that you've got rubber in a warehouse in Tokyo that nobody actually wants. So it's sort of a pretty nominal price. And so what you'll see is if you follow the Tokyo price down the curve into the front month, very strange things can happen. So at times, particularly, so when you award a rubber into Tokyo, you only get a certificate that's good for 6 months, and it can only be re-awarded once more. So effectively, rubber that goes into the system is only good tender for a year. After a year, you can't re-deliver that rubber anymore. So when rubber is coming off warrant, there's actually, in the whole of Japan, there is a market for about 1,000 tons a month of Tokyo ex-warehouse rubber. None of the big Japanese tire makers will take it. So let's imagine this month there's 5,000 tons of rubber coming off tender. There's only 1,000 tons of domestic demand for that rubber, which is filled by the Japanese trading houses like Marubeni and Itochu. The other 4,000 tons has basically got to get cheap enough to be exported to China. And that means it can go to $100 a ton, sorry, 10 cents a kilo, $100 a ton discount to FOB Thailand. Equally, if somebody, and it does happen, if some Chinese or Japanese speculative syndicate decides that they want to squeeze the front of the Tokyo market, that price can be driven anywhere. So the actual fundamentals, if you like, the supply and demand of the Tokyo warehouse delivered rubber is a very small exotic market that's prone to massive dislocations. So SICOM is a much more rational and logical market to trade. And it's your first decision. Whenever you're deciding what is the price of rubber, the real price of rubber is FOB Southeast Asia. And so that's always your reference. So when a Japanese speculator walks in, the more, if you like, the larger speculators, that's the first thing they're looking at, is what's the parity to Singapore. Similarly, when a guy walks into Shanghai, when a guy at Shanghai Chaos sits down to plot his next major strategy, what's the real price of rubber? It's what's the FOB price. So Singapore is the base market.
All right, Michael, the next question that we have is, this question is coming from a physical rubber trader. What's your take on rubber options, as there sometimes seems to be lack of liquidity in the market? How do you compare hedging using futures versus options?
So let's say in the ideal world, there is an argument that you'd only ever use options. So if you're a consumer, so typically as a consumer, what you're worried about is that you want to protect against the upside, but you're frightened of the opportunity cost if the market falls. And therefore, theoretically, a consumer more efficiently hedges himself with a call option than with a long future. Similarly, a producer more effectively hedges himself with a put option than with a short sale of futures. That's in the ideal world. In the practical world, the liquidity of the market, the bid-offer spread, are very important considerations. The Singapore rubber options market is still in early stages, and therefore it's a bit of it's a chicken and egg situation, that the market needs more participation to get a depth of liquidity that will enable people to trade more efficiently using options. But options have their attractions, as I'm sure many of the people on the call know, in terms of leverage, in terms of limited risk. You can tailor the payout to suit your risk profile, whereas Delta One futures are a blunt instrument. And particularly for a lot of people in the rubber supply chain, where cash flow is a big issue, the cash flow requirements of futures are quite a deterrent. And so theoretically, an option potentially lets you be much more efficient cash flow wise. So I think I would hope the Singapore options market can develop some liquidity and go on to thrive. But it needs, it's chicken and egg at the moment. People need to get in, play, get involved. Actually, it's been pricing as I've been looking. I trade a little bit for my own account in the Singapore options market, and generally it prices very well. The implied volatility is typically pretty close to historical. You don't get big. The market makers aren't taking big volatility spreads on you. So I would encourage people to educate themselves and start getting involved in the rubber options market.
All right, Michael, next up is rubber volatile enough for intraday trading? What do you think?
Historically, or let's say, it depends. There are periods of times when you can, and other periods of time where you can't. It's much better today than it was when it was a market-made market. So I was a big proponent for many years of moving to screen-based open outcry, because the old market making system that we had in rubber was very good for giving you a guaranteed liquidity, but it was in the market maker's interest to not encourage day trading. And so the bid offer spread meant that you didn't day trade, and the economics didn't lend themselves to day trading. So I think today you can, let's just have a look at the OR3 commodity GIP. I've got my Bloomberg in front of me here, let me see. So today you've traded a low of 36.6, a high of 38. So it's a quiet day. You could have bought a little bit at 37 and you could have sold a little bit at 38. So yeah, you could do a bit of day trading, but not a huge amount. Obviously there are days where you've got much bigger daily ranges, and then you can. So one tick is a quarter of a cent, so $2.50 a ton. I think brokerage is about $1 a ton, $5 a contract. So yeah, you can day trade. It's not clear what how you would make a decision on day trading particularly, but you can do it. Definitely,
Michael.
in Tokyo, there are a lot of people day trading in the Chinese market.
All right, Michael. Our next question is, what do you pay attention? I mean, where do you go to look up for news regarding rubber? And I mean, essentially, where's your best source for rubber news?
Rubber news. That is, again, historically, that's been a bit of a problem for an outsider, that rubber isn't well covered. That a lot of the information comes from people talking to other people in the industry. I think today there is much better coverage on Bloomberg and Reuters. Historically, it was a role of the brokers, particularly in Japan. So the Japanese brokers historically would very happily tell you who's buying and selling and so on and so forth. It's a bit more difficult these days in electronic markets, where even the brokers themselves aren't seeing where the flow is coming from. But yeah, the Bloombergs and Reuters of the world. And then if you want to do it in a bit more depth, you'll see a lot of the slides on here are attributed to a company called Landell Mill, LMC, which is a UK-based commodity analyst. He produces supply-demand work on rubber. The other source of statistics is the International Rubber Study Group, which produces the global, that's also the USDA for rubber. The International Rubber Study Group provides the baseline statistics for the industry. So it's the same as then, where do you get your news for the coffee market from? Where do you get your news for the cocoa market from? It's a combination of brokers, news services, people in the industry, and consulting type companies.
All right, thank you so much, Michael. Looks like that's all the time that we have for today. And thank you for being a wonderful audience. And we have so many questions today. I'm really sorry that we can't get through all of them. Rest assured that we'll get in touch with you offline. And we will be sending a follow-up email tomorrow with a link to the recording of this webinar, as well as the link that you can sign up with to sign up for part 2 of this series. All right, so tune in, look out for our email, and we'll catch you in our next webinar. Once again, thank you so much, Mike.
Okay, thank you.
All right, good night, everybody. Take care.